Do you think that the
Hey, good morning.
shutdown now in 6 days, in its sixth day, is having an impact here on the market?
It's hard to tell, but I don't think that's one of the major impacts. It seems to me that the biggest question, and you touched on this a few minutes ago yourself, Sarah, is whether or not the markets are signaling a slower 2019 than we would have expected, say, 2 months ago, 4 months ago. I myself think the answer to that question is yes, especially the second half of 2019. And I think so because we're starting to see a little softness in consumer confidence. We're seeing much lower commodity prices, which signify, I think, slower global growth. We're seeing bond spreads wider. We're seeing treasury yields themselves, the 10-year, quite a bit lower than 2 months ago, about 50 basis points lower. And consumer finances likely will be weaker next year, if nothing else, because of the lower market, although there'll be other factors. So I think this is the big issue, together with Washington dysfunction. I don't think the slowdown is the biggest the shutdown is the biggest element of the dysfunction. I think the trade war, I think the overall paralysis, the battle over the Fed, the investigations are all bigger factors than the shutdown because it probably gets resolved relatively soon. But it's a difficult environment, and we're seeing that in the market.
You know, nobody's been able to give quite a straight answer when it comes to how much the trade war is impacting company earnings or the economy at large. You know, we're not seeing any spike of inflation, which you would think tariffs or taxes, and they would raise the cost of living. We're not really seeing that, Roger. Is there a way to sort of analyze what kind of an impact the trade war is having on the U.S. and how much it's negating, say, the better corporate tax rate that we got from the administration down to 20%?
Well, I haven't seen a good analysis of that, although maybe there is one that I just missed. It's hard to do because the export share of the U.S. economy is relatively low, as we know, at about 15%. I think the bigger impact is likely outside the U.S., and China being a meaningful factor, and obviously that's affecting things like commodity prices, and that's affecting things, I think, like bond yields. I don't know how one would precisely calculate that in terms of the tax cut versus the trade war, although keep in mind that the full trade war, if you take everything President Trump has signaled he may do, is just really beginning. So I think that the impact of the trade war so far is more psychological and it's negative than it is flowing through the data. But that's just my sense of it.
Roger, this is Morgan. You talked about potential for slowing economic growth next year, especially in the second half of the year. Economic growth slowing is different than a recession, but do you see the risk of recession rising, or is that overblown right now?
I don't see a recession next year. I mean, if you step back, a couple of months ago, I believe, the forecasts for 2019 were centering around 2.5% growth, down from roughly 3% for 2018, mostly reflecting the disappearing impacts of the tax cut. Now I think we're probably looking at, and I don't want to try to be too scientific about this because it's way too early, a figure like 2% for next year. So not a recession, in fact, not close to a recession, but somewhat slower. And of course, the whole narrative, and we talked about this a couple of days ago, of synchronized global growth, which was driving everything 2, 3, 4 months ago, it is in effect gone because the rest of the world is clearly slowing. China's slower, Europe is slower than expected, and so forth. And so that narrative, which was a big reason why equities were so consistently higher, is no longer applicable.
Roger, deal making and IPOs, we have a piece up on our website saying that some of these unicorns are actually rushing to market because the back half of 19 and 2020 look even more treacherous than the first half. Is that what you're seeing?
Well, if I was one of those companies, I'd want to go sooner rather than later because the environment is obviously very volatile. But valuations are still reasonably good by any recent historical standards. So I'd want to try to take advantage of that rather than take my chances, 6 to 12 months from now. That's just what I think you would think if you were they, and I think what you would advise them generally. Of course, every company is different and every IPO is different, but generally speaking, what you would advise them to do, yes.
Roger, do you predict that Jay Powell will be in the same job this time next year?
Yes, I think he will. Keep in mind, and there hasn't been a lot of discussion about this in a precise way, the Fed chairman can only be dismissed, quote, for cause, unquote. And that would generally be interpreted as some form of malfeasance. So the President of the United States, whoever he or she is, cannot remove the Fed chairman because he doesn't like the monetary policy that the Fed is pursuing. Cannot do that. And if President Trump tried to, if he called for the removal of Jay Powell and asked him to step down, I'm sure Powell would resist, and I'm sure that there'd be a huge lawsuit, and the president would lose that because the language in the statute is quite clear. So the president cannot dismiss Chairman Powell. I don't think he's going to be foolish enough to actually attempt it. And I don't see any reason why Powell won't be in the same job a year from now, and I hope he is.
But where do you think this all goes into next year? Do you think, I mean, even so many people on Wall Street are now criticizing the Fed chairman, saying he struck the wrong tone, he made a mistake, they're being too stubborn when it comes to rate hikes and on a predetermined path instead of interpreting the markets and the granular data, which is suggesting that inflation is not running hot, and in fact the economy is slowing.
Yeah, but Sarah, that's a whole different question. I can remember many periods when there was heavy criticism of the Fed, and those things that happens. It's part of the job of the Fed. It's part of the overlay around monetary policy. That's a different question, whether you agree with the Fed's policies, than whether the chairman should be removed. If the chairman were removed, it would be hugely destabilizing from a confidence and financial market point of view. That is not going to happen. Now, you can disagree with the way the Fed has handled this most recent rate increase, both the fact of the increase and the messaging around it. And I think it's arguable that maybe that rate increase might have been deferred. That would have been my view. But I don't think any of that has anything to do with whether the Fed chairman should be removed. If we pursued that policy, and I can remember it very vividly when Paul Volcker took control of the Fed and imposed an extraordinarily tight monetary policy and generated massive criticism, turned out to be the right thing to do as we look at it years later. But we can't operate like that, and I don't believe that's going to happen. And I think Mr. Powell will be in that job a year from now. Yes.